For investors who hold gold, myself included, what do you think we're getting wrong?
You know, it's been a bubble. I've been saying that the Trump administration isn't going to just let the dollar devalue in perpetuity, that they will sort of recapitalize their balance sheet by force, frankly, if they have to. You're talking about a government with a $1.5 trillion military budget, the largest in the world. The thesis we raised in January is that as the price rose of silver, for example, that wouldn't bode well for a continued price improvement. It would mean that industry would work around silver. And that's basically what happened within 72 hours when the world's largest jeweler, Pandora, which accounts for 6% of the world's recycled silver demand, announced they would work around silver. But I've noticed amongst the gold stacking crowd, it has almost a quasi-religious feel to it. Like you're attacking a religious movement almost.
You also have to be a realist, right? And so how does it make you feel? You brought that point up about gold. Honestly, it makes me feel pretty good owning gold because I see the irresponsibility of government.
That rise in the price of precious metals, you would think mathematically it would just be the inversion of the debasement of the currency, but it's not. The weakening of the dollar cannot be associated with the increase in the price of gold. As simple as that math is, people don't seem to look at that, and yet they make that argument.
Do you not see deep value in some of the gold miners with the free cash flow they're pumping out these days?
I was joking with a friend of mine the other day, when Nick Fuentes got his gold contract to push gold, we should have thought, that's the top, right? Most people just want to speculate. They cannot help themselves.
Hey everyone, this podcast is not investment advice, and I'm certainly not a financial advisor. Just a guy who spends too much time reading about markets. Before investing, do your own research, talk to a licensed advisor, and remember, risk is part of the game. Welcome back. Most of you watching own gold, miners, and hard assets. I certainly do too, and that is exactly why I wanted to have this conversation. Today's guest is Father Emmanuel Lemelson, a hedge fund CIO and Greek Orthodox priest, who has recently outperformed the markets using strict balance sheet analysis and margin of safety discipline, while also pointing and perhaps debating that much of the gold and precious metals trade is still a little bit misunderstood and possibly mispriced. He's called metals a trap, challenged the stacking mindset, and questioned the silver demand story, which I find very interesting. He brings up some really good points. So he's also uncovering overlooked value plays the institutional crowd is ignoring. He's a deep value contrarian investor. And today I want to pressure test some of my own metals theses and dig into how he finds value in a volatile, narrative-driven market. So let's get into it. Father Emmanuel, welcome back.
Aaron, it's so great to be back on your show. I absolutely love your show, and thank you so much for the generous introduction. I think it's been too long since we've talked. It's been something like 4 months, I think.
Agreed. Where are you coming from today? That looks like a beautiful backdrop.
You know, I'm in hiding right now because of all the people who own gold and silver and are mad at me.
Well, that's
it's not a backdrop. It's real, though. I'm overseas at the moment.
You know, you've been public that you think much of the gold trade is at least misunderstood. For investors who hold gold, myself included, what do you think we're getting wrong?
Well, Aaron, there's a couple different levels. I mean, if we were to look at it just purely from an economic standpoint, I would argue that, it's been a bubble. And I've been saying that. In January, we published 3 articles on our Substack. You can go back and read. I think it started January 4th, and I think we did one January 8th or 10th or something. And then we did one really 24 hours before the historic crash in silver. Mm-hmm. And we actually called attention to that crash. And we said silver, when it gives, it's going to crash. And then there was within 24 hours, there was the historic crash, went down something like 33% intraday. There's an entire ecosystem around precious metals investing right now, and we've referred to that as the bezel, sort of embezzlement, in other words, where you have all of these sort of secondary and tertiary players who are making money off pushing precious metal sales. And sometimes it's innocent. They don't know necessarily that they're involved in that, but they're really giving investment advice. And from where I sit, Aaron, while we can make some maybe arguments about debasement in fiat currencies, that's the most popular one, right? People say, well, it's a fiat currency, it's going to be debased, but it's really hard to know what a government will do. We've argued that the Trump administration isn't going to just let the dollar devalue in perpetuity, that they will sort of recapitalize their balance sheet by force, frankly, if they have to. You're talking about a government with a $1.5 trillion military budget, the largest in the world. And we've seen that in Venezuela, where I think it was 17 or 18 trillion in oil reserves. And Trump turns around and says, look, we'll sell it to Russia and to China, and we'll do it in dollars. So the idea of the petro-yuan was sort of blown out of the water at that moment. Now they've sort of turned their gaze to Greenland, and that's going to be almost certainly annexed, and all of the trillions of dollars in minerals there. So this idea that the dollar is going to somehow succumb and we're going to become a banana republic overnight, it might work if we didn't have the world's most powerful military, but that's been sort of our position. But getting back to gold and silver, there's this whole ecosystem of people pushing gold and silver sales, and it's this thing that you're supposed to buy and pay to carry and lock it up in a storage vault somewhere, and then protect it in perpetuity. And it's always, the thing is, Aaron, it always is a fear-based trade, if you will. Mm-hmm. So it's never someone who feels optimistic about the future. It's always someone who thinks the worst is going to happen. So if you're, very often, if you're investing in gold, especially, a little bit less so with silver, because there's actually industrial use, as you know. A substantial part of that is utility in technology and solar voltaic cells and in jewelry and so forth. But apart from that, which is declining, you have to say, well, these investors aren't, in my opinion, aren't really using their God-given talents to analyze this investment very often. And forgive me, I'm not trying to insult him, but it's sort of a lazy investment, if you will. Like it's like just fear. Everyone's got sort of the same meme. It's it's the offset, the debasement of the currency, and then we buy it and we stack it and we store it in fear. And I just don't think that's the best use of our talents as humans, our God-given talents. And so when one of the thesis we raised in January is that, as the price rose of silver, for example, that wouldn't bode well for a continued price improvement. It would mean that industry would work around silver. And that's basically what happened within 72 hours when the world's largest jeweler, Pandora, which accounts for 6% of the world's recycled silver demand, announced they would work around silver. And we had put in that article on the 29th that we thought industry would continue to work against it actively. So there are real supply chain dynamics involved with some of the metals. And so, and then this idea of a store of value or a stable store of value, I just don't think it's sequitur because, Aaron, the thing is that when you have a commodity that has that kind of volatility in price, how can you call that a stable store of value or an ultimate store of value? It just can't be. And we pointed in some of our previous interviews to, for example, early 2011 or the early 1980s, right on the eve of the historic crash. I gotta say, and I just hope your listeners will forgive me. This is not an indictment. It's not a judgment. Let me just assure you, there's no greater sinner than me to the extent anyone's ever made a mistake. I'm not here to judge anybody. Please don't take it that way. But I've noticed amongst the gold stacking crowd, it has almost a quasi-religious feel to it. Like you're attacking a religious movement almost. And that's really, you got to worry a little bit about the spiritual health of that, because in the New Testament, the very first sort of time we encounter gold is really when the Magi are bringing the Christ child frankincense, gold, and myrrh. So they're giving it away. When we talk about talents, you bring up this word talents. It was a measure of a monetary unit. It certainly could have been gold or silver, but the one time you encounter the use of talents in the New Testament, and we've adopted talents in modern vernacular to mean sort of our charisms, our gifts, right, our God-given gifts. The servant, the unfaithful servant in Matthew 25, buries a hole in the ground and buries his talent there. And the master returns, and of course he's pretty angry about that. And he says, you should have at least invested with the bankers and earned interest. That's interesting because you're talking about usury at that point. And he's just incredibly angry. He calls him your faithless and wicked servant. But think about that, burying a hole in the ground and putting it there. Doesn't that sound like all these vaults where people put their gold and silver? And how are the talents really being used? So again, I don't mean this as an indictment or anything or a judgment against anyone, but I think we should at least ask these questions to the extent we're worried about how our activities make us feel inside.
You also have to be a realist, right? And so how does it make you feel? You brought that point up about gold. Well, honestly, it makes me feel pretty good owning gold because I see the irresponsibility of government. So it's more of an insurance play, right? It's like, well, look, they've showed the playbook. It's print, it's easy money, and I don't see any way out of it. So when you look at other central banks around the world, some of the most powerful central banks around the world, they're accumulating gold because they're scared of the continued debasement. History being our guide, we've seen since 1971 continual debasement of the US dollar, the world's reserve currency. So would it not
Sure.
be prudent to have the counterbalance to that, which is gold?
Well, if you just want to look at the math, I mean, equities have far outperformed precious metals in the last 50 years by a factor of like 5x. So if it's returns you're looking at, which I'm all about that, don't get me wrong, you couldn't compare gold to the S&P 500 over the last 5 decades. So
Yeah.
I mean, that's
20
easily
years,
just a Google
different
search.
story. Yeah, 20 years is a different story though, right?
Well, yeah, especially in the last 12 months, right, where we see this
Yeah.
exponential rise. But that rise in the price of precious metals, you would think mathematically it would just be the inversion of the debasement of the currency, but it's not. The weakening of the dollar cannot be associated with the increase in the price of gold. As simple as that math is, people don't seem to look at that, and yet they make that argument. And I would just
Explain
again
that.
go back. Well, I'm just saying, like it would be a 1-to-1 ratio, would you think, right? So if the dollar went down 1%,
Right.
if it really was a stable store of currency, then gold would go up 1%, right? And then you would really have really no gain, right? You would just have maintained purchasing power parity with a metal which can't really be used as currency. No?
Interesting. Yeah, I know.
But
exactly
getting back to this point of central banks, is the central banks the people we want to follow? And again,
True.
forgive me, I could be wrong because, I mean, they're not exactly the Mother Teresa types, but it seems to me that if it's fear that's driving you, you can't really have faith and fear at the same time. And you're going to say, Father Emmanuel, get real. I mean, your listeners might say this, come on, like you go back to church, like you don't belong in this arena. That's fine. But everything I'm saying will bring your talents to life.
You're also a very good investor. So, and you look at balance sheets, you look at income statements, you look for value, deep value. Do you not see deep value in some of the gold miners with the free cash flow they're pumping out these days?
Well, first, let me just say that thank you for the kind words, Aaron. But like anyone, I've made mistakes as an investor, to be sure. You know, like anything, there's, you can be good at something or not. And then there's the issue of experience, and everything requires experience. It can be a long road. I don't follow the miners, to tell you the truth, just because the price of the underlying commodity they're mining, I always believe to be too volatile. But I think if you were buying the miners, that would be much more legitimate and healthy activity where you could sit down and you say, let's look at the cash flow and see what's going on. And I think even Buffett, who's famously against precious metals at one point in the last 5 years, had bought a large miner, I believe, although he exited it fairly quickly. And it's not, I mean, he may not have bought it. Could have been Todd Combs or Ted Wexler or something. But the point is, even Berkshire, which is known for famously for being against precious metals, at one point did buy into miners. But I think that's a whole different game, because then you could talk about a company that has operational efficiencies, that may have some intellectual property, they may have some real competitive moat that their competitors don't. So it would take an actual intellectual activity other than just fear.
So you've published some pretty, for me, thought-provoking pieces on silver. I also own it. I own the related miners. Tell me again, tell our audience again, what makes you bearish on that metal, or at least concerned about the silver market fundamentally? In a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrustCapital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing with clear premiums over spot and no hidden storage fees, iTrustCapital offers something that still isn't standard in the precious metals IRA space. So if you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. Americans may be eligible for a $100 funding bonus when opening and funding an account with iTrustCapital.
I cut my teeth, Aaron, as a short seller in investing. So just to be clear, really my foray, my early life launching my first fund was really in identifying fraud. It's not that hard to identify when everybody's doing the same thing. You can look around you, and when it becomes a social mania, for me, it becomes interesting. I start saying, well, what's really going on here? And of course, I'm interested in the sociology and the psychology. And I'll be listening to a podcast at night, and it'll be something like I listen to Judge Napolitano, for example. I probably shouldn't mention that, but I kind of like the guy's show. He's got a nice podcast, but like every 5 minutes, he's selling gold and silver. I'm thinking, wait, this guy spent his entire life in the legal profession as a judge. And he's telling you this is how you're going to hedge your portfolio and protect yourself. And I'm like, how do you know that? You're not a professional investor. Why are you giving legal advice? So it seems to me the regulatory threshold's very low for everybody to be making money off the gold and silver trade, including those who don't actually own it. So everyone's sort of making a cut by promoting. So when I see an ecosystem like that emerging, it's really not that different than the dot-com bubble, or the housing bubble, or the tulip bubble. You start to say, well, and again, a whole village starts to sort of gather around it, and then there's the people storing it, there's the people insuring it, there's the people promoting it on the podcast, and you say everyone's getting paid, right? And like, I was joking with a friend of mine the other day. When Nick Fuentes got his gold contract to push gold, we should have thought that's the top, right? Like everyone all of a sudden is an expert on investing. In the dot-com era, everyone was an expert on .com. You just had to buy something that had .com and the price would go up. So what's the mindset of the speculator, Aaron? It's no matter what price I pay, silver at 117, silver at 85, it doesn't matter because tomorrow the price will be higher. And they believe they know that. And they create a narrative that lets them think they know the currency is going to be debased, but they don't actually really know that. I mean, they don't have a direct line to Trump or anything, right? Or the Federal Reserve. They just think they know that based on headlines on CNBC, which are hardly integritous. So in my opinion, the mindset of the investor, which is quite distinct, it's they're really complete polar opposites. They cannot be matched in any way. The investor says, well, if I can figure out what something's really worth, then hopefully I can pay less than it's worth, and I have a margin of safety in the event I'm wrong. So that, in my mind, is the definition of a true investor. I don't see ever a stacker thinking in that way, saying, well, I know that silver is worth exactly X. I'm going to wait for the price to go to Y, and then I'll have a margin of safety. I just don't see that happening. I hear just a lot of, again, sort of a repetitive narrative about that's fear-based. And again, I just sort of think there's probably a lot of wasted talents in that, because you've got a lot of very, very smart people like yourself, incredibly intelligent, great business person, successful by every measure. But then we enter into this activity that really doesn't put those talents to work, I don't think, in my opinion. Not necessarily you specifically, but I'm saying generally the stacking mentality.
I love to pressure test my own biases, right? Like I would say, I spend half my time speculating. I spend half my time looking for value. And I've lost a lot of money trying to be a good speculator. Made a lot of money, lost a lot of money, but I've had more consistency, shall we say, when I look for value. So I totally appreciate where you're coming from. And I intimately remember what you said. You said, people get last time you were on the pod, you said people get wealthy by owning productive assets for long periods of time. And I think you repeated it once or twice more throughout the show, and I appreciated that. So if gold and silver are not good in your framework, what do you personally trust to protect purchasing power in a debt-heavy system? My thesis, and this is one of the strongest theses that I have, at least in my own mind, is the debt is going to continue to grow, and we are going to continue to see demographics slide, and I don't think we're going to be able to fix this fertility collapse. So when I invest for the long term, those are the two most important elements I look at if I'm buying something for any duration of time between 3 and 20 years, let's say, because I have investments that I hope will match that thesis. But those two rules, because those trends I think are ingrained now, kind of they guide me when I'm picking long-term investments. So what do you, sorry, long-winded question, but what do you personally trust to protect purchasing power in a debt-heavy system?
Well, it's a great point. First of all, I agree with you on the debt, Aaron. And, there's a beautiful saying from Proverbs that the rich rule over the poor and the borrower is a slave to the lender. So, when you're studying a company, if you want to invest in it, if a company's going to have a lot of debt, it's going to be problematic. It could lead to bankruptcy, for example. Same reason personal bankruptcies occur. And it puts pressure on a company, and it takes away its energies and its focus from its vision of the product it's producing. And it starts to get into, managing its financial situation. But in terms of protecting purchasing power, you would say to yourself, where can I get the highest rate of return, right? Adjust it for inflation. And if it's really if you're really a currency, there's a lot of things you could do, right? For example, you could say, well, the dollar is doomed because it always, depreciates every year, but you could buy the Swiss franc, for example, which is the most stable currency in the world. It's not that hard to do. You can say, well, now I own a currency. It's not the dollar. There's so many options, but let's say you get a handle on what CPI really is. Let's say it's not really 3%. Let's say it's really 4 or 5% because the Department of Labor and Statistics doesn't, calculate it accurately. Then you would say, well, if compounded interest is the eighth, wonder of the world, then the difference between getting 5% or 10% or 20% is huge over this time frame you're talking about. I think you said 3 to 20 years, right?
Mm-hmm.
So you could go to a compound interest rate calculator online very simply. And you could just type in your base amount of capital you have and say, what if I got 5% on this, or 7 or 10 or 20? And you got to be honest with yours, because almost every investor I ever speak with, Aaron, and I mean every single retail investor, doesn't actually know their rate of return. Forget adjusted for inflation. I'll ask them a simple question. I'll be like, do you know what you paid in taxes last year? They know right away. Do you know your income? They know right away. And I'll say, do you know what your annualized rate of return over the last 5 years on your portfolio was? And they'll be like, what? It's crickets every time. And then I explain to them, it's not really their fault. It's their investment manager's fault. And they say, no, but he's great. I play golf with him. He's such a good guy. He really cares. And I say, well, if he really cared about you and you're playing all these rounds of golf, why don't you know the rate of return on your investments? And so then getting back to this interest rate calculator online you could go to, the difference between earning what an index would earn, an index fund like the S&P 500, which has been roughly 10% over the last, let's say, 5 or 6 decades, and what, say, a Berkshire Hathaway's earned, which is roughly double that, just go see what the difference is over 5 or 6 decades. You're talking about the difference between something like 40 or 50,000% return and in the millions percent return. So once you sort of hone in on that, you're like, wait, this is the most important thing for protecting purchasing power parity, as you point out, and to sort of outsmart the government's stealth tax, which is debasing the currency, as you accurately point out. Then the only question that remains is, where do you get the highest rate of return with the greatest margin of safety? So that's really all a value investor is doing. They're saying, where can I buy proverbial dollar bills for 50 cents? Because it does 2 things. It's almost certain to lead to a better than average rate of return when the price corrects. And it provides me with a margin of safety in the event I'm wrong in my appraisal of value. Hard to do with precious metals. Again, because you're dealing a lot of times with geopolitical factors and government policy, central bank policy, which you can probably never know unless you sit on the board, the central bank. And so I just think there's, so many easier pitches to swing at than things like precious metals, where all of a sudden, and by the way, even if you know nothing about reading financial statements and you're just have sort of in tune to sort of sociology, when you start to see everyone around you doing the same thing, you could at least question it. Because when everyone starts to feel like Warren Buffett and they're talking about how much money they made on silver or gold, is that different than everyone talking about how much money they made on housing in 2008?
Yeah.
Or in 1999, how much money they made on pets.com or some other throwaway .com business? Everyone was a financial genius. When everyone becomes a financial genius, I'd say be a little worried.
I've been feeling that way about, certainly now more so. I always question whether I'm in a crowded trade, and gold and silver certainly have felt that way. But I've also felt that over the last, call it 24 months on and off, about the U.S. markets as a whole. Everybody's putting in these investments into passive income funds, beating inflation, generating a real return, feeling wealthier. It does. U.S. equities has felt crowded for years now.
Yeah. We just published an article today on our Substack. To the extent people are interested, it's a pretty interesting article, but talks about how the Vatican Bank actually just paired up with Morningstar to release their own indexes based on ethical investing. I don't think it's very ethical, actually, what they're doing, but it's a fascinating history. It goes through, what the Vatican Bank has done, and they've, dramatically underperformed like any other mutual fund or index fund. Well, index funds don't underperform their own index, but they've underperformed value, in my opinion. Yeah. Like a Berkshire Hathaway, which itself operates like an index fund because it's a large and diverse conglomerate. But, you should be worried about it, because if you look at the actual premium you're paying right now, it is a historic high. So being aware of that, even though people keep pushing it higher and higher and higher every day, you can't overlook that historically it's the most expensive market we've ever lived through. And yet, Aaron, notwithstanding that, for the true value-oriented investor, I think there are still great opportunities. And that's what we try to point out on our Substack articles, walking people through the analysis, say, look, despite all of the craziness in the market and these extremely high prices, you can still from time to time find great value, because so much of that trading activity is algorithmically driven. And those algorithms are written, frankly, by speculators. And the mistakes aren't just made on the upside, they're made on the downside as well.
And you've made some great calls of late, but you're always the first to say, I've made bad calls too. And, it doesn't always work out. But walk me through your actual process when you think an equity or asset is mispriced. Let's say break it down on a high level. Let's say, what are three key metrics you look for when you're trying to find a deep value opportunity or an potentially undervalued equity?
Sure. And I just to make a correction there, and God forgive me if it sounds immodest or arrogant, but I actually said that I've made mistakes, not bad calls. Incidentally, right. We have a glory be to God, not because of me. We've had an incredible track record of being right. My mistakes have been in other areas in investing. There's a lot of ways to make mistakes, but not in terms of our analysis. I don't think we've been wrong hardly ever. Maybe never. I'm not sure. I have to go back and look over 15 years.
Walk us through what are three key metrics, and I know there's more, but if you were to say, what are the three most important metrics you look for when searching for value, what are they? In a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrustCapital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing with clear premiums over spot and no hidden storage fees, iTrustCapital offers something that still isn't standard in the precious metals IRA space. So if you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. Americans may be eligible for a $100 funding bonus when opening and funding an account with iTrustCapital.
Well, I think at first it's good to stick to areas you understand, industries. And then a lot of times you'll just read on CNBC or Bloomberg or something, you'll read about a company that has this huge precipitous fall. We're living in a period where not only markets keep going up, but we're also seeing extraordinary volatility, beta. And a lot of times people associate beta with risk. I think that's a logical fallacy. And just getting back to what I said earlier about, our analysis being right, it doesn't mean that our allocations always produce alpha right away. Sometimes we look like we're wrong for a while. Like we recently, meaning about 6 months ago or so, we made an investment in a company called Flower Foods. And, it's actually down, although this year it's up substantially. And I believe at the 1 year mark or maybe a little bit later, we'll probably be outperforming the benchmark. So sometimes in the near term, a value investor looks like they're wrong, only to be proven right in the longer term. But, you can find companies where there's a precipitous drop in price. Like we, for example, you mentioned Comcast earlier, and that stock was really beaten up just a few months ago. But, we try to walk the readers through an analysis of the balance sheet and the statement of income and the statement of cash flows. And the better you get at reading those three financial statements, the more comfortable you get with it, which is not hard initially. But like anything, the more you do it, the more it becomes second nature, the more you're going to find mistakes. And sometimes you can just look at what the sell side is saying, the analysts, when they downgrade something. And sometimes they're right. But a lot of times they're wrong, or they're overlooking things, or they have undisclosed conflicts of interest. And you can just sort of compare what they're saying against what the management team's saying themselves in the conference calls or their earnings reports, and say, does this make sense? I mean, is it really going to be as bad as everyone says, or is there hidden value? For example, one of the investment ideas we recently published, I think we initially labeled it number 15, but it's actually number 16. We've put out 17 investment ideas in the last, 7 or 8 months. But this was an iconic American company, an industrial company that people are saying it's like left for dead. But if you took a closer look at it, you were actually getting all the assets of the company, the entire thing, the manufacturing, the factory, the inventory, everything, for a company that was over 100 years old. You're getting it for about 70 cents on the dollar, with zero value placed on the brand of the company. And I just thought that was extraordinary. They happened to make a product that I love. Their sales were actually going up. So the sell side analysis reports would make it sound like their sales were going down, but they really weren't. I mean, certain product categories and overall unit volumes were actually going up. And so they had actually also freed up a tremendous amount of cash on their balance sheet for an aggressive buyback. The company only had a market cap of about $2.5 billion, and they had authorized $1 billion buyback. So at that level, you could buy back 40% of the shares. So without incurring any tax, you would, if you were an ongoing holder and you bought at this depressed price, which was lower than the onset of the pandemic, like when the whole economy was shut down, for crying out loud. And the company has been around for, again, over 100 years with no threat of bankruptcy. Nobody was suggesting they were going to go out of business. And you're buying tangible assets, Aaron, for 70 cents on the dollar, and zero value placed on the brand, which honestly, I thought if you burnt down all their factories, they would be a room full of bankers ready to put them back in business just on the strength of the brand. Their brand strength is incredible. Like, I'm talking like Coca-Cola, incredible,
right.
That level. Where's really the risk in that? There's a huge misunderstanding because the analysts, again, sometimes have They have misguided or misaligned incentives, and then they're kind of part of the groupthink. Groupthink can be very, very powerful. So in terms of the human component of allocating capital, Aaron, some of the rarest qualities are the ability to think independently and the ability to lead when the crowd is going somewhere else. A lot of people just don't feel comfortable doing what everyone else is not doing. And I see it time and time again. And you got to sort of be able to do that, I think, to get some clarity and a clear framework on where you're allocating capital. So getting back to your question, I would look for companies that you understand the industry, where there's some sort of precipitous price drop, and find out, is it really valid, that price drop? Is it warranted? And if the answer is no, then take a deeper dive. If the answer is yes, something's fundamentally wrong with the company, there's a secular change in their industry, or there's a management problem, or they're too heavily leveraged, then you obviously back away. But sometimes it's as easy as just starting with a list of, companies trading at a 52-week low or near a 52-week low, and just sort of picking through. And do I recognize any of these names? Are they companies I understand? Why are they so cheap? Why? Like this one had a P/E of like 4, Aaron.
Wow.
Great, iconic American company, 4. And it's just unbelievable. So while CNBC keeps talking about, SpaceX's IPO and Nvidia's stock price and what's going on with Micron, and so you're showing you like half a dozen names that you're supposed to be watching, and then gold and silver, of course, flashing red lights every day. Nobody's looking at these dollar bills for, I would say it wasn't even 70 cents on the dollar. It was like probably 30 cents on the dollar because of the brand equity. No one, they're just sitting there in plain sight. No one's talking about them. They're not on CNBC, and yet everyone knows the brand. Everyone knows the company. So, we recently just took a look at our last 8 investment ideas because they were more recent, and all of them had outperformed, and we had outperformed the S&P by, I think, a factor of 10x since we published those. So, and again, showing our method every time, just walking through sort of old school Ben Graham, if you will, sort of the dean of Wall Street, mentor to Warren Buffett, going through the financial statements. If you're not doing accounting, if you're not reading accounting, Aaron, I'm hard pressed to understand how it's truly investing. And if you don't like accounting, if you don't like reading financial statements, it's going to seem very laborious, and then you're not really going to know what you own. You'll know the price, but you won't know the value.
And how will you have any conviction in that scenario too, right?
That's right.
Probably
and then you'll be
won't.
skittish, and you'll be dancing out of everything. And it'll go down, and you'll sell it, and it'll go up, and you'll buy more, and it'll be, buy at the top, sell at the bottom kind of stuff. And it'll be a repetitive cycle that consumes your mental energy.
When you typically take a position in one of these value plays, is it short? Are you usually short term, or can this last for years, or is it just a mixed bag?
Yeah, it's a great question. So what you're asking is, when do you sell, right?
Yeah, are you looking short term? Are you looking for a little?
Never. Well, I shouldn't say never. If it's a short position, it is inherently short term, but I tried not to short too much anymore, to tell you the truth. Such a terrible business. But generally, let's say you've got this compounding engine, right? It's the internal dynamics of this company that produces a widget, and they may have a competitive moat, right? Like take Apple. It's not easy for someone to break in because everyone's on the Apple platform and they control the operating system and the hardware and all this other things. So if it's compounding and its return on equity is above average, and let's say it's returning capital through buybacks or a dividend, and let's say overall you start to realize you're getting like over a 10% return, maybe you're getting 15 or more. Well, as long as that's going on, there's no reason to sell it, because all you're going to incur is a tax liability. So the questions are, is it overpriced? Is there a fundamental change in the business that means that the direction of the business is going to now, suffer as a result? If the answer is neither of those, if it's fairly priced or even a little bit of a premium because it's still growing, and there's nothing wrong with the company, all you're doing by selling is you're incurring a tax liability that hitherto had been postponed and deferred in perpetuity without interest. It's a loan from the government that you technically owe them, but you don't have to pay it until you sell. So, and to be honest with you, Aaron, if we're talking about buying dollar bills for 50 cents, how many times can you find it a year? Maybe a handful.
Not much.
It doesn't happen that often. Now, we went through a great streak recently with these 17 ideas, but that's sort of unusual. But at the same time, it's also a golden age for value investors, believe it or not, in my opinion. I thought long and hard about this, and I just think that the outrageous volatility and the people throwing away great companies because the sort of jamming into the half a dozen or so names CNBC perpetually talks about is giving rise, this beta is giving rise to enormous opportunities. So despite the markets being at such highs and being at such a premium and being so dearly priced.
Value investing, it certainly seems like a contrarian thing right now, as crazy as that sounds. How do you feel?
It's always contrarian.
Really?
Sure.
What Why do you say
Because
that?
my experience has been, Aaron, that it's a personality type. That most people just want to speculate. They cannot help themselves. They can go to Columbia, sit in the same classroom Ben Graham taught in, get 5 acronyms after their name that makes them sound really authoritative, and they will still prefer speculation over reading financial statements. It's just a wiring. I see it time and time. I have friends who are great CPAs and accountants, and they've worked for big funds. They can read financial statements in their sleep. And honestly, they'd rather be on DraftKings, so to speak. And the more the stock market looks like that, the more exciting the action seems, right? It's like the action. They get excited by it. They cannot help themselves. So value investing is always constrained. It always has been, in my opinion.
So last question, Father, what, and this might be too broad, but I want to test. I want to see what you think, and because I'm very curious on this. Where do you see the S&P going this year? I know it's such a mixed bag right now. Like I think 20% of the S&P is down well over 10% over the last 6 months. Where do you see it going? Are we getting top heavy? It certainly feels that way. It's felt like that way for a couple of years now. But what do you see for the markets this year?
We've written about this in some of our articles, but it's very, very dear, the price. It's extremely expensive. It's like you wouldn't go out and go car shopping when the price of cars was like during the pandemic, when the price of cars shot up and dealerships were charging, $5,000-$10,000 for an SRP. Terrible time to buy a car. Generally, it's a terrible time to invest in the market, but unless you're buying an index fund, that shouldn't stop you from doing the work of an analyst and looking for individual security. So like Wall Street, since the beginning of Wall Street, it's really a bunch of guys sitting around talking about where the market's going to go next. That's the oldest question, isn't it? Is it going to go up? Is it going to, actually, the truth is none of us know. It will definitely go down at some point, in my opinion, because the American society and economy is predicated on these cycles. And I believe also the Trump administration is addicted to volatility. I think in some level, this is not an indictment of Trump, it's not political speech, but I think on some level, his brain is wired for drama. And I think the era of March 2020, when the world went into economic shutdown because of the pandemic, it was oddly exciting for a group of people who actually made an enormous amount of money. The gyre between the ultra wealthy and everyone else expanded exponentially following that. And you can see sort of, he's got Lutnick and these other guys in the Oval Office. And every time there's a massive fall, like when they announced the tariffs last April, which we said there's a great buying opportunity for retail. It looked like the sky was falling. Shortly thereafter, when he changes direction, they're in the Oval Office joking about, this guy made 50 million, this guy made 70 million.
Yeah.
I mean, you don't want to be the feedstock for that, but that's not going to change. As long as this administration's in office, they're going to stoke volatility, in my opinion. So when the S&P is a whole, it comes back down to earth to something like a P/E of 15, which is more of a normative historical average. I don't really know the answer, Aaron, but I know that we're going to see a lot more volatility, I think, from this administration. I think they want that.
Yeah. Interesting take. Father, it's always a pleasure. Where can our viewers find you online?
Well, we'll send you a couple of links through the description. You can put them there, but our Substack is it's lemelson.substack.com, I think, the URL. We have a podcast on YouTube. It's at Lemelson. You can find us on X at Lemelson. We post pretty prolifically on X. Same thing on Facebook. We're pretty much everywhere. LinkedIn, not too hard to find, but we'll send you some links. And if it's not your trouble, you can put them in the description. I just want to say our Substack can be a little expensive, relatively speaking. Actually, I think it's really cheap in the greater scheme of things. But, Aaron, I love your show. And if you'd like, we could do a special link or something for your viewers to reduce the cost for them to, get access to this other view of things, which is the security analyst view. And we could, reduce the price by 2/3 or something for your viewers if you'd like. That would
be great. And I'm a reader of your Substack, and I will say it has been tremendously valuable for me. I love your securities analysis, and I also love your broader, I'll call it macro outlook as well. I think you tie finding value and your macro outlook in very, very well, and it's very different than the typical guest that we have on our show. And it's a sobering viewpoint for speculators like myself, and I'm sure a lot of our audience. It opened my eyes that, oh, wait, there's actually different ways to make money in this market. You don't have to be in these typical trades. It's good. It's sobering but optimistic for me. So I enjoy reading your stuff. It's fantastic.
Glory be to God, Aaron. Really grateful to hear that. It's a lot of work, and just hearing comments
Yeah.
like that makes it all worth it. And I'm really, really grateful to hear that feedback. Glory be to God.
Appreciate it, Father. Thank you very much for your time.